Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Well, good everyone. Thanks for joining us on the Smart Property Investment Show. We're going to do a podcast today, one that we haven't done for a little while, where I get a couple of my colleagues, editorial colleagues, in the studio to have a chat about what's going on in the market. The names may sound familiar. They've been on before. Aleks Vickovich, who is one of my editorial colleagues. He looks after our wealth and legal portfolios here at Momentum Media. And James Mitchell, he is the equivalent of him, but he looks after mortgages. So essentially these guys are money guys, and you do a bit of law, but let's not worry about them today.
Sure.
Aleks, how you going?
I never worry about lawyers, Phil. You know that. You see my defamation suits when they come through.
I always worry about lawyers, particularly working with Aleks. So I see the defamation suits coming through, which, let's be fair, don't happen all that often. And you're yet to cop anything for anything you said around the property market. So let's see if we could agitate and anger someone today. I'm sure there's some disgruntled listener out there.
We'll have a First Amendment one day.
We'll do it.
We will do. And James, thanks for joining us again.
Yeah, no worries, Phil.
I know you guys are huge listeners of the Smart Property Investment Show. You can't wait
100%.
for every single episode to come out. We do it twice a week, which is great. One of the things I do like about this podcast is its diversity. So by and large, I speak to property investors and get a story on how they're going about creating wealth through property. And I know you guys are looking to embark on that journey yourself.
James is a little closer than I am.
James is a little closer.
With the bub on the way.
Yeah, absolutely. But also get like experts in and experts in property, and we share some of these similar, let's call them editorial contacts or resources we use, people that run sort of big data companies, people that provide insights, analysis, interpretation of what's going on in the market. But then also I'd like to get you guys in the studio, just have a bit of a nag about what's going on. And last time we got together, we spoke in depth. It was early days in the Royal Commission. It was at a point in time where they were going through the mortgage broking industry. They're subsequent to that, or prior to that, I can't remember exactly the cycle, they went through risk advisors, so insurance providers, and they went through financial advisors. Aleks, that's your sort of big thing at the moment. They're looking at...
So there was one in between. So the mortgage and credit was the first one.
Yep.
There've been 4 rounds now. We're in the 4th round. Second round was wealth management and financial advice. Third round was SME lending.
Yep, that's right.
Small business loans. And now they've gone to the regions, which I do think is important. They're up in Brisbane at the moment looking at farmers who've been ripped off, essentially, farming finance. They're also going to look at general insurance, so disaster claims, claims on natural disasters, bushfires and storms and floods. And then next week they go to Darwin for something that hasn't really been covered, I don't think, ever before, which is really the interaction between Aboriginal and Torres Strait Islander communities and financial institutions. So we'll see what's come out of that.
That'll be really interesting.
That's really interesting. And, the big focus of this Royal Commission is essentially how Australians are receiving financial products, receiving financial advice, and where the responsibility lies between, is it the financial provider's responsibility to ensure that someone can afford something or actually receive something, or is it actually skullduggery on behalf of the providers of financial services?
That's right.
That they're not giving products which actually really exist or are relevant to someone. So the jury's still out. What do you think, Aleks, is going to be the key result of this current Royal Commission?
Well, look, I think it's tough to say at this stage, because I think one of the criticisms that is starting to emerge is that, they really are still focusing primarily on the big 4 banks. And I think that as someone who was kind of advocating for that because it hadn't been done in its entirety before, that's a good thing to some extent because it's a powerful inquiry and these are powerful organisations. But I do think that, if you were to look at it at the moment, because they've only really focused on those organisations and a few small businesses here and there, you'd assume they'd have some sort of widespread reform of the banking sector. But I do think that as the Commission goes on, it's going to broaden and it's going to focus on other parts of the financial system, superannuation, for example, which hasn't really been touched on. Hasn't been touched on, and it has to happen. I think the skeptic in me thinks that it's probably going to be right before an election, so they'll probably do that last.
The focus on super?
Yeah, the focus on super, because the banks are close with the coalition, industry super funds close with Labor, so you want to do them last. So that
you sound like a cynical journalist, but I'll let that one slip.
I've got no facts. There's just an insinuation.
Did you actually have an opinion on this? This is the idea, right?
We don't know what sets
Finger
the
in the
strategy
wind
in
stuff.
terms of what we don't know why they're doing what when, but we can guess.
Yeah.
At the moment, I do think it's important that they've gone to the regions. I do think that there will be some significant regulatory backlash. We've spoken about this on the show before, and hopefully that doesn't get into a bad place for investors, for borrowers, for normal mums and dads, because the whole point of this is to end up with a better financial system, one where people can rely on the services and the products that they've purchased, and one where people aren't getting ripped off. And I think it's good that we're airing this stuff. It's really important. But if you end up in a system where where it's more difficult for them to access financial products, where there's less competition because only people that can be lawyered up to the eyeballs can play in the market, then I think that's a worse outcome. So, I think the Royal Commission's doing good work. I don't really trust the ability of politicians to implement the findings, but we've got to see what those are first.
My view would be trust our leaders, trust our elected leaders. They've got us, all of us Australians, in the back of their mind to try and support. But I want to get on. I want to get onto the mortgage market in a second, James. But before I get there, Aleks, you've been on some aeroplanes recently, from what I understand. I haven't seen you around the office. I know you're out there flying the flag, doing what you do for your particular suite of products here at Momentum Media. You been in the States?
Yeah, I've been in the States.
Recently?
Actually, there was a fascinating property development. I'm going to write about it for Wellness Daily, which is, of course, a publication we launched last year, which James Mitchell here is really heading up. The property crowdfunding market over there is something that's really emerged. It's kind of tech-based property crowdfunding. A lot of it is where, developers are putting up marketing offers directly onto a sort of platform. But what's been really interesting is that the people I was talking to, who are pretty major property developers in New York City, were saying that a wellness focus is really driving the market over there in New York at the moment. So everything needs to have that green element to it, and there needs to be, that kind of a focus on mental well-being and health.
So how people are living in their homes.
Absolutely.
And the feng shui and that sort of stuff.
Absolutely. And incorporate it into the actual building.
Yeah, yep.
And because they're probably a couple of years ahead of us with this trend, it's very cool New York type of thing. But I really wonder whether that might have an impact then on property markets elsewhere. You're starting to see the buildings emerge with vines growing up the side and a greater focus on green. So that was really interesting to see these guys. And these guys were not, one of them was a bit kumbaya, but the others were hard-nosed property guys.
Yeah,
and they were saying, capitalists.
Create
and they
the
were
product
saying,
that people want.
Yeah, exactly right. And they were saying in Manhattan, the Wall Street guys won't back us unless there's this wellness focus, this green focus. So I thought that was of interest.
That's really interesting. So two things there in unison. One is the crowdfunding for property development. So this is someone pulls a whole bunch of money from very small investors, might be $1,000 here, $5,000 there, $20,000
Yeah, well, they
there,
changed.
whatever.
So the Obama administration changed the rules. So before, similar to Australia, only sophisticated investors could engage in equity crowdfunding. So they changed the Obama administration brought in the Jobs Act, which allowed non-sophisticated investors to play in this game. There's still some rules around it, similar to kind of what we're trying to work out here. It's not entirely clear where our crowdsourcing laws are kind of ending up. There's quite a lot of restrictions on ours, but overwhelmingly the US has kind of gone gung-ho into this market, and that's had a flow-on effect for property. In the state of Texas, for example, there are no restrictions whatsoever on equity crowdfunding. So a 14-year-old kid can invest $50 pocket money into a milk bar startup, and that's just the way it works over there. So I think different states have different cultural attitudes in terms of risk and reward and lobbying and all that sort of thing. But yeah, fascinating to see that crowdfunding market really develop, and for property, equity in property to really be the first cab off the rank in terms of the implementation of it.
So things moving ahead here in Australia will start evolving and changing in line with some of the themes and attitudes we're seeing in America.
Yeah, I think so.
Yeah.
Look,
We've already got BrickX, don't we?
We've always got
exactly.
BrickX.
You've got BrickX, you've got groups like Domicom who are really providing fractional property investment, but they're doing it in a sort of traditional managed investment scheme type format. So there aren't too many who are doing the kind of straight up transactional tech platform style that you're starting to see in the US. But, regulations allowing, I really see that could be a positive thing.
Yeah, interesting. So moving on to mortgages, James, and I know this is your backyard. You deal in mortgages every day, and I think you probably are one of the most connected men in mortgages in Australia that I know. You can pick up the phone and chat to anyone, which is a good thing and sometimes a bad thing, because if you write the wrong thing, you get a phone call for something you don't want.
Plenty of phone calls, yeah.
Mortgage broking, so the advice provided by brokers to consumers has gone through its round in the Royal Commission, and rightfully or wrongly, we'll probably see some changes to the way in which mortgage brokers operate and also remunerate. But what we're also seeing now is it looks as though the bank's trying to divest some of their mortgage related assets. Either it's to satisfy regulators or satisfy the market or satisfy their customers or satisfy their shareholders. Yep. What's happened this week in particular?
So this week, CBA have demerged their wealth and mortgage broking business, which is Aussie Home Loans, and their wealth businesses, so Colonial First State and a few others. They basically bundled them up and spun them off into a group, or they will, into a group called CFS Group, and that will list on the Australian Stock Exchange. as a separate entity, completely separate from the Commonwealth Bank. But shareholders in the Commonwealth Bank will also get shares in this business.
Every shareholder in the Commonwealth Bank will receive shares in it?
I believe so.
Is that how it works?
Yes.
Okay.
Well, I mean, they already are shareholders in it. I mean, the businesses remain. It's just the ownership structure changes and it becomes listed separately. So it's not a traditional IPO.
No, it's not. A demerge is what they're calling it.
Yeah.
But it will, it'll be a listed group. But what's interesting is that Aussie Home Loans has been lumped in there, and Alex and I have spoken about this before in some depth, and it's a bit of an anomaly, having Aussie in there, because you've got all these wealth businesses and then you've got Aussie Home Loans. But I think what it does do to a degree is gets rid of some of the conflicts of interest, which have been brought up by the Royal Commission. Representatives from Aussie were a witness in the first round of the Royal Commission hearings, and so were CBA. In the Royal Commission, as you watched some of the questioning by the councillors assisting, you saw this, I guess, confusion in terms of some of the data which the CBA was reporting, and it's like, hold on, is this the Aussie business or is this the CBA business? And it's like, no, this is CBA's controlling this. And there was a lot of confusion in terms of keeping the books separate and all that sort of stuff, and where the responsibilities and lines of command were. And I think that muddiness or that murkiness is something which really came out of those hearings. It's something which was highlighted in the Productivity Commission report, and there was also some Productivity Commission hearings. The final report is due out pretty soon. So the draft report basically came out and said that the mortgage broking revolution has failed because all these broking businesses like Aussie, for example, set up in the early 1990s to challenge the major banks and be an alternative. And they did. And they undercut them significantly. That was a place and time thing because of what the banks were doing with rates and gouging and that sort of thing. But then obviously as they grew, they sold to the major banks. So I think the perception out there is that, there are conflicts of interest. How can a group like Aussie Home Loans be owned by Commonwealth Bank and there not be conflicts of interest? So yes, CBA have demerged this group. Aussie is included in that. I see it as a preeminent thing. I think that it's a foreshadowing. They can see changes happening on the horizon.
Jump before you push, do you think?
I think they're jumping before they're pushed.
And I think you're totally right, James. And they probably will, had the banks not get out of the wealth management space and the mortgage space in terms of brokerage, which they are now of their own volition, it probably would have been a recommendation of the Hayne Commission and still may be. I personally think with the Aussie thing, and in fact, I think it was on this program where I was talking about it being conflicted with Aussie Home Loans and the CBA.
That's
I think,
right.
Phil, you and I had a bit of a debate about it, but I think in this circumstance, it's a great thing because they have removed the conflict, but also Aussie's a great brand. It's one that consumers have an affinity with. It took on the banks, Wizard Home Loans and Mark Boris did a similar thing, and it was good for the country because it provides competition, it keeps the bastards honest. And I think that, they went through this process where they went and they bought all these businesses, which was legitimate. They did it for shareholder reasons. They didn't do it because they're evil. They did it because they thought it was going to work. It didn't work. Yep. And I think it's good that it's all kind of changing now. But
they held it for about a decade, So I think it was 2008 when CBA bought its first 20% stake in Aussie.
Yeah, and they've taken tranches of it over time.
They take tranches over it. 2012 was another big one. And then John Simon sold his final 20% share last year.
He's still got a hell of a lot of Commonwealth Bank dividends.
Well, yeah, he that was.
I'm sure he's not struggling.
He's not struggling. That was in.
You hang out with him, don't you, James? You tell us.
I don't hang out with him, but he literally sailed off into the sunset, I believe.
Yeah, he's based out of Tropez or something now, isn't he?
Well, I think it's fascinating, and it is a good thing, as I said, and the banks are simplifying. That's the language they're using.
Yes,
but that's
not a bad thing though, and that's been one of the biggest outtakes of my read of the Royal Commission is that banking as a profession and banking as a tool and engine for supporting Australians to create better lives for themselves sort of lost its way a little bit. Everyone talks about the 80s being a great decade of banking before. Banks used to be consumer focused.
That's right.
Banks used to have a personality, and
community
banks used
focused.
to be community focused.
They used to fight for market share like
used
normal
to fight
businesses.
For market share, and then things change, and banks become these massive behemoths where potentially profits and shareholder value become in front of what is best for the consumer. So maybe this is just a bit of a reckoning for the market and a bit of about facing getting banking back to where it should be. And
that's a positive. But I think let's not skirt around the fact that all of us in this room and everybody listening is a Commonwealth Bank shareholder, or almost everyone. Anyone who has a super fund is a Commonwealth Bank shareholder. And this is a very expensive reckoning. I mean, they spent hundreds of millions of dollars, if not billions, not just the Commonwealth Bank, but all of the banks on these businesses over the last 20 years. So it was a very expensive mistake. Plus there was the advice they were paying for from, these fancy consulting groups like McKinsey & Co. who told them to buy it in the first place. So I do think that we're getting to a better place for
You said
investors.
the M word, the mistake word. Who's calling this a mistake? Who's calling
Well,
the state of a banking institution a mistake?
Well, it's a mistake in that they bought these businesses, they weren't able to capitalise them and make them work for them, so they've had to sell them off. So the original hundreds of millions that they spent in acquisition is essentially wasted shareholder money. I mean, they've still been very profitable in the interim.
And also, if you look at Matt Comyn, the CBA CEO, if you look at his comments, they very much mirror, and this plays into what Aleks was saying in terms of the simpler bank strategy. They play into what Shane Elliott from ANZ has said, from what Andrew Thorburn of NAB has said, simpler bank. Basically, all three of them have come out and said, we're going to sell off our wealth businesses to create a simpler, better bank. And NAB CEO Andrew Thorburn, he even said, the complexity is killing us. That's a direct quote. The complexity is killing us. So basically,
they're complex businesses.
They're complex businesses, right?
Well, they're a lot more complex than they used to be.
Yeah, and so they've created these sort of like monsters which they don't really know how to manage or handle, so they're having to get rid of them and almost go back to basics. I reckon the future of Australian banking over the next 5 years at least will be more sell-offs like this and a return to your old school savings and loan.
I agree.
Over the next 5 years. That's all Aleks wants is a Dolomite account in his little central dragon.
Don't get me started on Dolomites. Don't get me started on that.
Savings and loan. That sounds good.
It does. And I reckon over the next 5 years, you're right, but over the next 15 to 20 years, you'll see them start to buy distribution again. All these things are cyclical. The lawyers and the management
ANZ
accountants.
snaps up CFS Group.
Exactly right. KPMG has to come up with a report saying something for the money that they're spent, right? So they have to say things like, go and buy that. Should we invite him back,
James?
Yeah, absolutely.
We need a pillar of negativity.
He's great.
I think we're heading to a better place.
He's
better place for investors.
He's good value.
What else is going on in mortgages, James? So let's remember. So we're talking property investors are listening to this. So I think this is all really relevant. Just to give context to the market.
Yeah. Well, I mean, all this is interesting. I think one thing that property investors should be aware of is that rates are on the rise, particularly from the alternative lenders and non-majors. And that's a result of...
What's a non-major? It sounds like industry speak.
It is industry speak.
Yeah.
Basically, it's any bank other than the big four banks.
Okay, any ADI, so any ADI. Authorised deposit-taking institution.
Yeah, that sounds like industry speak.
LVR. Yeah. Do you know what that means?
Yes. So basically, you've got Macquarie, Suncorp, the regionals, Bendigo and Adelaide Bank, these types of institutions.
So rates are going up.
Rates are going up. Bank of Queensland's increased its rates, and so is Auswide. And one of our journalists, Charbel, he gave Auswide a call because he wanted to find out why they were increasing the rates. There wasn't too much in the release which they sent through, so he wanted to do some more digging. Managed to get through to the CFO, had a chat with him, and he said that they've had a severe increase in funding costs, and it's forcing them to increase their rates. And this is
funding costs.
Funding costs.
Yeah, we need to explain this because our listeners might go, how does funding work? So banks borrow money themselves, right? They reborrow it onto someone else.
Okay, yeah. So I'll lay it out. I'll lay it out simply. And this is something which we talked about in the Mortgage Business podcast. So basically, the major banks, the big four banks in Australia, get about 65% of their funding from deposits, from the money you and I put in the bank, and they use that money, and 65% of their funding comes from that. The rest comes from a mixture of long and short-term capital from overseas and some from domestic. So basically, they're using international money markets to get their funding. So what happens overseas, like the Fed in US hikes rates, and you see that in the international news, that'll have an impact on the funding costs of that 25%.
So that makes the money that they're getting more expensive because they're getting it from global markets.
Exactly. Yeah. And there's a lot of, because it's such a global interconnected world that we live in now, particularly in terms of finance, volatility in different markets affects the costs of funds. So 25% of funding from the major banks will be exposed to that volatility. It's a bigger proportion for the smaller banks because they don't have the same scale of deposits that the majors have. Just not as many Australians bank with them. They don't have that share of, wallet. So they're more exposed to that volatility. Therefore, when funding costs rise, they're forced to increase their rates to keep up with that. One of the, I guess, biggest misconceptions, I think, among people who take out a mortgage, just among maybe Australians generally, and possibly listeners from your show, is that the RBA cash rate is what determines your mortgage rate. And that was because between 1997 and 2007, just before the GFC, for that 10-year period, if you look at a graph of the RBA cash rate and the standard variable mortgage rate, the correlation is almost identical. So you had all those volatility factors still playing out. It's just that they weren't impacting things as much, or if they were, it was in line with what the RBA was doing. So basically the RBA could move up or down, and then mortgage rates would move up or down by 25 basis points. So it gave off this perception that whatever the RBA... That it was tied.
Yeah.
Exactly. But in 2008, there was a big break from that. The majors did their own thing and have since been doing their own thing. They've hiked rates out of cycle. We've now had the RBA cash rate on hold for 22 months. Since then, we've had rate hikes, we've had rate cuts from various different banks. So you've got the funding cost as a problem, which is what's relevant today. But then you've also got the macroprudential curbs. So the banks have used pricing as a lever to, shut down investors to a degree, interest only. So there's all these cross currents of factors playing into how mortgages are priced, and basically what happens to the rates that your listeners are paying on their mortgages, which is quite a complex story to tell, and particularly from a bank or I think a mortgage broker perspective. If your client's getting a letter in the mail and their rates increased by 25 basis points, and you've just found out that the RBA has kept the rate on hold for 22 months, what the hell's going on?
The argument I get people who know a little bit about this but not enough, they'll say a couple of things. They'll either go, well, I borrowed my money 2 years ago, so this shouldn't impact me because I got that money back then. And then, or they'll also say, why don't they just give me the bit of money which is from deposits and therefore is not open to any global factors which might change pricing? It shouldn't matter for me.
I mean,
why is everyone impacted even though it's only a small part of their funding?
Well, this is the sort of economic argument for for what makes rates change. That's if you speak to an economist, they'll tell you this sort of story. Then you've got to think about, are the banks telling the truth or not when they say rates are going up by 25 basis points because of funding costs? You know what I mean?
This is what angers a lot of people. And this goes, if you go back to...
It is a very convenient excuse to put some
for what is a commercial decision.
The only people that benefit from that is the bank and also Australia Post, because they've got to send out a letter to
that's true.
Many people.
We're for the posties here.
We are for the posties. This goes back to when you look at a lot of the disruption in the 90s around mortgages, where you had your Mark Burris's from Wizard and your...
This goes back to the Aussie story.
Aussie stories going out there saying, there is so much fat in their margins, we'll just come in and come in cheaper, and all that noise around global funding markets and all this sort of stuff, we're going to give you a better deal. So, we'll wind up this podcast, but at times of market flux of cycles that we're going through right now, there's got to be some innovation.
There will be innovation.
Online.
In fact, there's some, I probably can't talk about them yet because I don't think they're ready to go to market, but there are some new, almost like a new breed of mortgage manager, new breed of non-bank, who are very digitally savvy, different way of securitizing, and they're going to come out with some very sharp rates.
That's another term, non-bank. What's a non-bank? Not a bank.
They're not a bank.
So there's people that get their money from somewhere else.
A non-bank basically means they don't take deposits.
Well, even the big four might be innovative. They finally gave me a credit card, and I've been in the garden for a long time, so I don't know if that means I can probably get a home loan now, and it's happy days.
I reckon
I might become a property investor next minute.
I got a call from some of the restaurants around Sydney and say, businesses down, give Vicko another card.
They did.
It's probably true.
Yeah. Probably is true. Okay, good. So I'm a property investor. Listen to us yabber on about all this stuff. By the way, really interesting stuff. Thank you. But what should you be thinking? Going, all right, how's this? What's this got to do with me? What do I do? How do I understand this more? What do you do? Go to a mortgage broker? Can they explain what's happening?
I'd say so. I mean, I'd say spend some time seeking out the people in the know. I mean, industry experts. I mean, just do plenty of reading. Be curious. That's the only advice. I'm a journalist, you know what I mean? Like, so I've got to be naturally curious about what's going on and finding out.
And take advantage of the situation, right? I mean, this is a horrible PR time for the banks, even though, I mean, if from a pure business point of view, these are organizations that are the highest performing retail banks in the world.
That's true.
In terms of their profitability, in terms of their shareholder dividends. As a business journalist, we should be singing their praises, right? But because of this misconduct story, they're getting smashed day after day. Yeah. So if there's ever been a good time to, negotiate and haggle with somebody who works at a bank, I think it's now, because they're very conscious that they're not, in good favour.
Well, they are open for business, going back to getting a credit card. So,
I'll be giving them some interest.
Yeah, give them a call.
Just quickly.
No positive press, though.
Did you take the limit they gave you, or said, I don't need that much, I just need this much?
Yeah, no, as much as possible.
You took as much as possible. And this is the spiral, listeners, people getting into debt.
Well, avocados are very expensive, Phil.
When you hear the RBA talking about it's really high debt to income, 1 ratio.
Anyway,
I went into it willingly though, James. That's the difference. I wasn't scammed by the bank. I was scamming myself.
Give it 2 years.
all right. Good. We'll come back and check it. When are you investing in property, by the way?
As soon as I clear this debt, it'll be my first decision. I've got my eye on a few.
He's got to rack it up first.
Yeah, your problem is, though, it's a good thing as well, is you get a lot of exposure to investments outside of property. So, you're heavy in this wealth space around, the myriad of financial products which are out there to consider investing in outside of property. So I know you're a huge advocate for always diversifying a portfolio, whatever it is, and to consider products. But that again, if you don't understand a product, it's probably not worth investing in.
Absolutely.
You're a Bitcoin man,
I've been listening to the Smart Property Investment Show, so I'm leaning towards that asset over time.
Yeah, confidence. All right. Thanks, Aleks. Thanks, James. Appreciate your time. And if anyone's got any feedback about these two, positive or negative, and I prefer the negative feedback, gives me plenty of arsenal to give them a hard time around the office. You can email the team, editor@smartpropertyinvestment.com.au. But if you've got any questions around what we spoke about, you'd like some more information, look, there's plenty of stuff on smartpropertyinvestment.com.au. But email in and we'll try and connect you in with the info if we can help you out with that. If you're not subscribing yet to our daily morning market intelligence newsletter, so you're the first to know what's going on in property, smartpropertyinvestment.com.au/subscribe. If you like to get your info from social media, you can find us, love us, follow us, like us, whatever you do these days, Smart Property HQ. Please remember those 5-star reviews are really appreciated. I've said it beforehand, it's more than just me standing here behind the mic. There's a big team, there's an engine here that keeps driving forward to keep building this community around property investments. So as well as myself, that team really enjoy the reviews from you guys. Let us know what you think and we'll keep trying to improve. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.